Now we are ready to discuss the weighted average cost of capital. We've came a long way, right? Until now, we talked about risk-free rate, cost of debt, cost of equity, equity premium and beta, and then weighted average cost of capital would be a combination of all these things, okay? Finally, let's go. So, in weights for the cost of capital computation, well, in computing the cost of capital for a publicly traded firms, the general rule for computing weights for debt and equity is that you use market value weights, not book value weights. We always like market value, okay? But why is a question. Why do we take market value weighted average of these cost of debt and equity? Why market? Why not book value? Okay? Is it because the market is usually right? Market is efficient all the time? Is it because the market value are easy to obtain? Or is it because book value of debt and equity are completely meaningless? None of the above, okay? So first item, well, market is usually right. Well, if you believe market is efficient, why would we try to do valuation in the first place? The value investors like Warren Buffett and Jim Rogers, this kind of guys, they don't believe in market efficiency in the short run, okay? It deviates from the fundamentals. Price deviates from fundamentals. So market value right now, okay? It's not usually right. Still, you try to use market value. Why? And market value are easy to obtain. Well, not that easy, especially if you think about the market value of debt. Okay, market value of debt. Well, not many companies have their corporate bonds listed and then just gets traded out there. Okay, market value or market cap of market value of equity. Okay, maybe relatively easy to obtain because you have the stock price moving every millisecond and then the number of shares outstanding easily available. Okay, but market value of debt is horribly difficult to obtain, right? Still, we try to use market value. Why? Is it because the book value of debt and equity are completely meaningless? And the answer is no. And the answer is no. The book value of debt and equity, they have their meaning, and then we need them, okay, sometimes, right? And then the auditing and all these kind of accounting processes gets involved, and those are meaningful in certain sense, right? But why do we take market value weights? Because we take the perspective of the market investors today. As of today, how do they evaluate the company, your company, so much so that when you raise capital in the market today, how much reward would you have to consider them? How much risk reward trade off that you have to consider, okay, when you attract new investors today? I told you before, put yourself in the shoes of the private equity investors who want to, take over certain company and restructure it. And for that private equity purpose, you have to ask the investors in the market, like Warren Buffett or somebody like Apollo Fund or whatever, like Blackstone, right? You have to ask those guys, Schwartzman, right? This kind of big shot guys in the market, and then raise capital with their money. Okay, when they invest in that your fund, they will look into the market value of the corporations if your portfolio company. So you have to take the perspective of those guys in the market. Okay, their eyes today. How do they evaluate your portfolio company? Okay, so that's why we take the market value weight when we compute the weighted average cost of capital. So weights for the cost of capital computation. So weights used to compute the cost of capital should be the market value weights for the debt and equity. So the market value of equity should be nothing but share price times the number of shares outstanding. And then market value of debt is usually more difficult to obtain. I told you before, okay? Even the Samsung Electronics, their corporate bond, how much is it, right? And those bonds rarely gets traded, maybe once per day, whereas Samsung Electronics stock gets traded every millisecond. Okay, so the price itself is difficult to obtain. Moreover, the Samsung Electronics, even for Samsung Electronics, the biggest company in the country, in Korea, they have huge amount of bank debt. Okay, they borrowed with a private loan transaction, loan contract. Okay, those loans, bank loans, are not traded frequently and not traded at all in the market, even compared to their corporate bonds. So loan contract is a private contract, private transaction, not priced in the market day by day. Okay, it's difficult. Still, we try to get the market value of debt. There is an element of circularity that is introduced into every valuation by doing this. Since the values that we attach to the firm and equity at the end of the analysis are different from the values we gave them at the beginning. So what are you talking about? Well, the final destination, okay, our final destination is the market value of your equity, okay, market value of your equity. But to get to that market value of equity, okay, you have to start with the market value itself, okay? So there is a circularity, but we just live with that, okay? As a general rule, the debt that you should subtract from the firm value to arrive at the value of equity should be the same debt that you use to compute the cost of capital. Now, tax rate. Which tax rate? Marginal tax rate. I told you before, not effective tax rate. The choice really is between effective versus marginal tax rate. Effective tax rate is defined as the tax amount paid divided by the taxable income, profit before tax. The marginal tax rate, well, that is the tax rate the company faces on its last dollar of income. Marginal tax rate, okay? 한계 세율이 얼마냐? So in the US, the federal corporate tax rate on marginal income is 35%, with the additional state of local taxes, and most firms face a marginal corporate tax rate of 40% or higher. And then the different countries have different marginal tax rate schedules. And then in doing valuation, it is far safer to use the marginal tax rate, since the effective tax rate is easy to be manipulated by managers in the accounting books. So I told you before, right, in the midterm and then before previously, okay, because we take the perspective of the private equity who is trying to consider, do we have to take a certain project or acquire certain companies and do some restructuring, and we have to have to stand at the last dollar of profit before tax and to make a decision based on it. So that's why we need to work with the marginal tax rate. Now, dealing with preferred stock, well, when you consider the weighted average cost of capital, it has to be weighted across different source of capital. Okay, debt, equity, something in between is preferred stock. So what should be the weight and then the cost of capital for preferred stock? When dealing with preferred stock, it is better to keep it as a separate component. The cost of capital, the cost of preferred stock is the preferred dividend yield. As a rule of thumb, this is the preferred stock is less than 5% of the outstanding market value of the firm. Well, just lumping it to the debt will make no significant impact on your valuation. Just lump it into debt. Okay, ignore it. Okay, preferred stock. What is that? The definition of it? Well, preferred stock is a kind of equity. Okay, and then, well, for common stocks, if the company cannot afford to pay dividend, you can always skip paying in dividend payment for common stocks. But for preferred stocks, what do you do? Well, they have a priority. Okay, think about the priority boarding in your airplane travel, right? Priority. They have cash flow priority relative to the common equity holders. So preferred dividend, you can skip it if the company is in a terrible situation. You can stop paying preferred dividend, but rarely you do that. Okay, you pay the dividend to these preferred stockholders first, and then move down to the common equity holders and say if they, if you want to pay dividends to them or not. Why do you issue preferred stock in the first place? Because you don't want to dilute your ownership. Okay, the preferred stock, well, they don't have voting right. Okay, they don't have voting right. They just have the cash flow right, priority cash flow right. That's preferred stock. But when the voting goes on to fire the CEO, hire new CEO, or whatever corporate M&A decision making, preferred stock, get out of here. Okay, only the common shareholders, they have the voting right. Okay, so that's the distinction between the preferred stock and the common stock, right? Cash flow right is preferred over there, no voting right. Anyway, now if the preferred stock portion is very small, ignore it. Lump it into debt. Why debt? Why not equity? Because the cash flow going to the preferred stockholder works just like interest expense, or it's not legally binding, but conventionally you just have to pay the cash. So that's why just lump it into debt. Recap, the cost of capital. How do you compute this? Well, cost of capital, weighted average cost of capital, or WACC, or WACC, WACC attack, all right? That's this guy. Well, that should be cost of equity times weight of equity plus cost of borrowing times 1 minus tax rate times weight of debt. Okay, so weight of debt and weight of equity, that's understandable, market value based. And the cost of equity, we know how to do it using cap and beta and whatever. Cost of debt, we know how to do it using the default spread and risk-free rate. But what is 1 minus tax rate? Because interest expense is tax deductible. So only the after-tax portion of cost of debt is what matters over here. So that's why we multiply 1 minus t, okay? Marginal tax rate. Now, estimating cost of capital, the textbook author brings interesting example of Brazilian company, EMBRAER. Equity cost, well, cost of equity for that company was starting from risk-free rate 4.29%, beta 1.07, and times market risk premium of 4.82%. Then it became 9.45%. Market value of equity, 11 billion Brazilian real, which was equivalent to 3.7 billion, 3.8 billion US dollars worth. What about the debt? Well, cost of debt, he started with a risk-free rate, again, 4.29%, plus 4% coming from the Brazilian default rate, because they have significant business exposure in this emerging market called Brazil. That's 4%, plus 1% default spread. So that turned out to be 9.29% cost of debt. Now, market value of debt was found to be 2 billion Brazilian real, which is equivalent to 713 million US dollars. Now, what is the cost of capital, weighted average cost of capital? Well, 9.45% above here, and that comes here. And then weight of debt, okay, based on this and that, okay, this will be, if you aggregate these two, it will be 4.4 billion US dollars worth. Out of it, $3.8 billion, that's going to be about 84%. So that's why we have it over here. And then cost of debt, that comes from here. And then 1 minus marginal tax rate, 34%. And then the weight of debt. So that gives you 8.92% WACC, okay? Now, current practices of estimating cost of capital. Well, here, before we move on further, what do we do with this weighted average cost of capital? Well, this is going to be your discount rate when you do the firm valuation, when your cash flow estimate that you're going to learn in the next video is free cash flow to firm. Then you will have to use this WACC, okay, to discount and then get the firm value or enterprise value. Then cost of capital computation, how does it work in practice? Researchers have accumulated by surveying the CFOs, and then they found out, well, current practices, well, majority of them, 81% of the firms use the CAPM to estimate the cost of equity. 4% used modified CAPM, and 15% were uncertain about what to do, right? And then 70% of the firms used 10%, 10-year treasuries or longer as the risk-less rate. 52% used published the source for a beta estimate, while 30% estimated themselves. And then there was a wide variation in the market risk premium used, with 37% using a premium between 5 to 6% equity risk premium. And cost of debt, about 52% of the companies used marginal borrowing rate at a marginal tax rate, and 37% used the current average borrowing rate and the effective tax rate, which is wrong, okay? So once you go to the industry, you'll realize that many of your bosses make mistakes, and then you have to correct them, okay? Now, weights for debt and equity, 59% used market value weights for debt and equity in the cost of capital. 15% used book value weights, and 19% were uncertain about what to use, okay? Now, some more thoughts about, and then the questions. Well, firm value and equity value. To get firm value to get from firm value to equity value, which of the following would you need to do? A, subtract out the value of long-term debt. B, subtract the value of any debt that was included in the cost of capital calculation. C, subtract out the value of all liabilities in the firm. Which one is the correct answer? The answer is B. Okay. B, not the whole liability. C is not the answer. Okay. If you look at the liability section, it has unrelated items there when doing this valuation. Okay. For example, deferred tax liabilities, right? A huge amount maybe sitting over there. Is it related to raising capital in the debt market? No, that's why. And then accounts payable. Okay, accounts payable. Is it related to raising capital? No. Accounts payable, we're going to learn it later, but it's something called a part of the operating cash flow. Okay, it's related to inventory. So it's not related to your cost of capital calculation. Instead, notes payable, it is related to raising capital. Commercial papers that you raised, okay, that is a short-term borrowing. And then current portion of long-term liabilities, right, that is maturing within 1 year. Okay, that kind of stuff, or revolving loans. These are short-term loans, short-term bonds, raising capital, okay? Each should be included. So not only the long-term interest-bearing debt, but also the short-term interest-bearing debt should be included in the debt value. And then those debt value, okay, funded debt or interest-bearing debt, total amount, long-term, short-term aggregated, those should be taken out of the firm value. Okay, we're going to do it later on, so wait for that if you're not sure what we are talking about. Things will get clearer as we do some example later. Now, doing so will give you a value of the equity, which is A, greater than the value you would have gotten in the equity valuation. B, less than the value you would have gotten in any equity valuation. C, equal to the value you would have gotten in an equity valuation. Theoretically, C has to be true. Okay, C has to hold true in very ideal setting. Okay, whether you do the firm valuation and get to the equity value, or you do the direct free cash flow to equity method and estimate the equity value, you should end up with the identical equity value. But in practice, okay, you will realize you will end up with different numbers. Okay, so there is a lot of friction in the market, and then you have to think about different items and to worry about. Anyway, so let's please wait for the next video. Thank you for watching.